Hello all, welcome to my channel. My name is Prajakta Bapat. Today's video is about ratio analysis and interpretation part 3. This video is in connection with the previous two videos. In previous two videos, we have discussed about two categories of ratios. First is liquidity ratios and second one is profitability ratios. Today we are going to discuss about capital structure ratios. Before that, let us understand what is capital structure. So, for any company, there are various sources of finance which are available. Like they have bank loan, they have debentures, they have shares. But these sources are broadly classified into two categories. First is owner fund and second is borrowed fund. So, in this category of ratios, we will see the proportion of debt and equity. That is proportion of borrowed fund and owner fund. Debt meaning borrowed fund and equity meaning sources of owners fund. Debt does not mean, first understand, debt and equity are two broader terms. Debt does not mean only debt which you have taken, which you have borrowed. Debt includes debentures, bank loan, public deposits and any other loan which is taken from outsiders. And equity does not mean only equity capital, it means owner's fund or shareholders fund, which includes equity shares, preference shares as well as reserves and surplus. So what is the purpose of calculating this capital structure ratios? So we get to know the proportion of companies debt and equity capital, as well as it tells about long-term stability or solvency of the business. In this video, we'll be discussing three capital structure ratios. So first ratio is debt and equity. As I said, debt and equity are broader terms. So we will see what it includes and what is the formula for that. So ideally the formula is like, just to remember, the formula is like debt upon equity. Okay, but if you consider only debt as a debt and equity as a equity capital, it will go wrong. That's why the actual formula is loan funds upon shareholders fund. So debt meaning loan fund. So whatever amount you have borrowed from outsiders, whatever you have taken loan, it is numerator, that is debt, and equity meaning owner's fund or shareholders fund, which includes preference, equity and reserves and surplus. So loan fund upon shareholders fund. But just to remember, you can remember the formula like debt upon equity. Standard ratio is 2:1. So ideally, company should have more debt, double of debt than equity. Next ratio is capital gearing ratio. Now, what is the purpose of this ratio? So, we will try to see here that whatever amount of capital company has, whatever sources they have used, out of that, how many are fixed interest bearing sources and how many are not fixed interest bearing sources. That means on what sources company has to pay fixed amount of interest or dividend, and on what sources company doesn't have to pay fixed amount of interest. Obviously both categories has their own pros and cons. So the numerator, if you see, it is loan funds and preference share capital. So obviously numerator is fixed interest bearing securities, because on all loan funds, whether you take loan, whether you take debentures, you have to pay fixed interest, and on preference shares capital also you have to pay fixed dividend. So numerator is obviously fixed interest bearing securities upon non-fixed interest bearing securities, meaning variable income interest. So first is equity share capital, then reserves and surplus minus fictitious assets. Okay, so this is capital gearing ratio. Now the third one is proprietary ratio. Now proprietary ratio is shareholders fund upon total assets into 100. Now when I say shareholders fund, I think so by this time you are familiar with this concept of shareholders fund. So it includes equity, preference shares and reserves and surplus. So basically this is owner's fund. Okay, upon total assets. So when I say total assets, it is total of your asset side, meaning fixed asset, investment and current asset we consider into 100, because I want this ratio in the percentage form. These are the three ratios we have discussed about capital structure. In the next video, we'll be discussing about the next categories of ratios. If you like this video, make sure to subscribe it and share it with your friends. Thank you.